cash flows are not as manipulatable. All right, so that's going to be one of the metrics. One of the other reasons is going to be the timing of cash. Right, we have to adjust for the timing for cash receipts because that is what is necessary to evaluate cash flow. We don't know with any certainty if we are going to receive a promise of cash in the future. So expected cash flows are going to be relevant. Right, cash flow adjusts for actual cash changing hands, and that's actually that transaction when cash actually exchanges hands is the true economic event that's going on, and we're going to see why a little bit later today. All right, so we're going to look at a couple fictional examples that help illustrate these differences. All right, so let's say that this magazine company, right, this example is going to be going completely out of phase soon enough, I think. But it really illustrates really well the differences between cash and accrual. All right, so let's say we're dealing with a publishing company, sold a 3-year subscription to 1,000 customers. All right, so customers pay in full upfront. So $300 upfront, 12 issues once per year, $25 per issue. Additionally, the company takes out a $100,000 3-year loan. Interest is accrued and fully paid at the end of the loan life. All right. So we're going to look at what the effect is now on accrual-based income generated from the situation relative to the cash-based situation, and how this all affects the balance sheet. Right. Every transaction is reported and can be reflected in the balance sheet. So we're going to look at what these events result in when we're looking at the company's financial statements. Oh, additional cost of publishing is $60,000 each year. Right, so this is the company's expense. All right. So first, let's look at the cash flows. So the company has a full cash inflow of $300,000 in the first year, but then no cash inflows in the preceding 2 years. All right, so all of the company's cash inflow is front-loaded at the start of this time period. But there is operating and production costs occurring each year in $60,000. Right, so the total operating cash flow for this company at the start of this time period, $240,000, and then it starts losing money from here. Right, we have operating cash outflow in the second year, no operating cash inflow. Then we have operating cash outflow in the third year, plus interest paid on our loan for a total cash outflow of $93,000. Now let's contrast this with what the income statement is going to be reflecting. All right. So first, it's important to recognize that cash receipt of $300,000. That's not the transaction of providing the magazine. That's the upfront cash payment that customers are going to be paying to receive those magazines in the future. So as companies are sending out those magazines and companies are receiving them, that is the transaction that's going to be reported on the company's income statement. So in that first year, they receive $100,000, right? And they're going to receive $100,000 each year after. Keep in mind, this is purely based on accrual accounting. Right? One of the first drastic differences we see between cash flows and income. When we're looking at the company's cash flow, they receive that $300,000 at the very start of the time period. That's pure cash inflow. But when we're based on accrual accounting, that company is recognizing the revenue as it is making that transaction, as it is providing those magazines to the companies. Conversely, publishing distribution expenses occur the same exact way. Right? This company has the same $60,000 expense for producing and distributing these magazines. It's occurring in each year. Right? So no differences in the operating costs of this company. And the last difference, whereas in reality the company's total cash outflow from its bond is occurring in the last year of that bond's life, it is starting to accumulate interest. Right? So that interest expense is going to be reflected in each year and built up over time. Nominally, these are all the same values. Right? If we look at the company's revenue, right, that's getting $300,000 in revenue. $300,000 in cash. When we look at the company's expenses, they also add up. And when we look at the company's interest expense, it adds up as well. 10 plus 11, 21, plus 12.1, 33.1. So all of these values match up explicitly. The biggest difference, though, is the timing of these cash flows and revenue recognitions and expense recognition. Right? And so this is one of the most important discrepancies between cash and accrual accounting is accrual accounting doesn't reflect when cash actually changes hands. It reflects when transactions occur, when you exchange viewing rights to a company's content, when you exchange for taking a plane trip after you paid for it a month or two early on. Right? So keeping in mind this difference is one of the most important distinctions between evaluating a company via net income and evaluating them through cash flow. Cash reflects when it changes hands. Accrual accounting does not. And there is actual value implications for these structures. Right? Generally speaking, do we want to receive money earlier or later on? Everything else equal. Yeah. The earlier we receive a cash inflow, the more valuable it is. The further out into the future we receive our money, the less valuable it is. What about expenses? Everything else equal, would we prefer to incur an expense as early as possible or as late as possible? Yeah, exactly. Right? Exact same idea with cash inflows, but now we're dealing with an expense. The later on we can pay off an expense, everything else equal, the better off it is for us. Right? The further we can extend cash outflows, the more valuable that transaction is. Right, so we see a couple things here going on with the cash flows. This is a good structure cash flow wise. Right? We receive our cash inflow as early as possible. And for any cash outflows that we have discretion over, in particular the loan structure that we take out, it's taking place as early as possible. Right? So optimally speaking, if this company is running itself well, this is the best way to structure these events. Right? Rather than receiving the $100,000 each year, we receive that $300,000 up front. We can take care of our operating expenses, but now we can use the rest of that $200,000 for productive purposes. Right? If we don't have any immediate projects available, we can invest in appreciable securities, probably safe ones, something like Treasury. We can earn a little bit of interest. That's going to help offset the effect of inflation that is going to erode the value of those future cash flows if those cash flows would actually occur in the future. Okay. On the flip side, postponing the interest that we're paying on this loan, if we're paying the same nominal amount, then we're having the exact opposite effect, but on our costs. Right? We're reducing the cost of the company just by postponing it into the future. Any questions so far on the differences between cash flows and accrual accounting? All right, so graphically speaking, right, this shows us the differences in cash flows and accrual income. Right, when we're dealing with the operating cash flow, we had the large cash inflow at the very start of this time period, but from there, cash flows plummeted. On the accrual basis, though, because revenue didn't occur until the transaction of the produced good or service occurred, we have this smoothed out income over the time period. But on a time value of money basis, we know that the situation that this company occurred with, receiving its cash inflows early on and postponing as much of its cash outflows as possible, is a great situation for the company to be in. Right? If you were to be in the exact opposite situation, it would actually put you in some potentially significant financial difficulty. Right? If the company owed $93,000 at the start of this time period, but didn't receive its money until 3 years in, that could be problems for companies. Right? That sort of cash flow structure can lead to financial difficulty. It would necessitate taking out additional loans, if only to just be able to meet that expected future cash inflow. Right? So generally speaking, you want your cash inflows prior to you incurring your cash outflows. Same thing with your own life. If you start taking on payments on your part. If you start taking on expenses that you don't have cash inflows to match, that's putting you in some financial difficulty, because the only way out of that is to either take out loans or somehow default on the expenses. Both of those can put you in worse financial straits in the future. All right, so everything else equal, we want to receive our cash inflows as early as possible, at least earlier than the expenses that might be tied to it. All right, so when planning out your own life and looking at your own budget, really good idea to try to understand the timing of your expenses, when they're going to be occurring, and try to make decisions that you have control over to have your cash inflows that match or precede those expenses occurring. All right. Now we're going to look at how all these transactions are going to be affecting the balance sheet. Right. So at the top level sort of idea, right, we know that income statements are going to affect balance sheets through retained earnings. But in reality, each one of these economic events are going to be reflected in a balance sheet, just not necessarily at the aggregate level at the end. All right, so let's say that a company would also issue some common stock. All right, if the company issues common stock, its equity is going to increase by $50,000, and that's going to be offset by $50,000 in the company's assets. All right, remember, this is a balance sheet that we're dealing with. Everything has to net out over time. The issuance of debt. That incurs a $100,000 liability for the company, but it also is going to be balanced by $100,000 in an asset that the company is going to hold on hand. All right, now things are going to start getting a little bit more interesting. So the company receives the cash inflow of $300,000 and can increase the cash held at the company immediately at that time, but it's going to increase the company's liabilities by $300,000. What is the balance sheet on the liability side reflecting this $300,000? Let's see if it's available on Walmart. No. All right. Just pulling up Capital IQ. So we could look at another company. All right, so we'll go to balance sheet. Liabilities, unearned revenue. All right, that's very difficult for you to see. All right. So unearned revenue, current and longer term portions. All right, so the offsetting liability that we're dealing with in the balance sheet for this company earning this $300,000 up front is unearned revenue. All right, so basically revenue that the company is going to have to earn sometime in the future to offset that balance. So current portion usually within the next 12 months, and then there's longer term portions, unearned revenue non-current, that companies can also incur. All right, so this $300,000 is reflected in unearned revenue, meaning the company hasn't provided the good or service that is tied to getting this cash inflow. Then we have publishing and distribution expenses. Right, this is cash outflow from the company, so at the bottom line, it's going to be reducing our owner's equity and cash available. And in each year that the company pays off, or not pays off, but provides the magazine that its consumers have subscribed to, we're going to be reducing that unearned revenue and increasing the retained earnings through profits of generating that revenue. And lastly, there's the accrual of interest, right, which is going to be a reduction from owner's equity and an increase in the interest expense. All right, so again, all companies are different. Not all companies are going to have this sort of structure, right? So looking at unearned revenue. I popped into Walmart just to happen to see if it happens to have that unearned revenue portion in its balance sheet. It doesn't, so consumers aren't purchasing that sort of subscription service from that company. Okay. Companies that have sort of subscription products are more likely to have that unearned revenue, or they are going to have it in their balance sheet. Right? Again, companies operate differently. Their financial statements reflect those differences. Any questions on how the income statement is affecting balance sheet items? Moving forward into the next year, right? We have more publishing expenses, so again, further reducing our retained earnings. Recognizing more revenue, right? Now it's no longer unearned revenue. It's revenue that has been earned because we've provided the product that we've promised and tied to this subscription income. All right, so we offset our unearned revenue by $100,000, increasing our owner's equity. Again, keeping in mind that these balances are offsetting one another, right? The expense in retained earnings is netting off, or the expense in owner's equity is offset the revenue. And similarly, the interest expense is also offsetting that revenue. So everything that we're looking at within these financial statements is basically each line item is going to be reflected in the balance sheet as it is being incurred. And keep in mind that just because these transactions are occurring on a financial statement doesn't mean cash events have occurred. And it's those cash events that are important. Right, so when we're making investment decisions, right, what is the expected value that we're making these decisions on? What's the expected value that we are valuing assets off of? Not quite, right? There's an explicit measure that we use to value assets, right, if we're looking to value a company. We've already talked about it a little bit today. There you go. Cash flows. Yeah. Not trying to make a trick question out of this. The value of any asset is the expected discounted cash flows that asset is going to generate. All right, so whenever we're making a decision on whether or not an investment is worthwhile, whether it's from the corporate side when you're valuing a project, if you're on the investor side looking at assets to park retirement money in, or if you're managing money on others' behalves, you're still looking at the expected cash flows. You have to adjust those cash flows for the timing of them because time value affects the value of cash flows. Right? So whenever we're making a decision, it's based on the expected cash flows. All right? So that being said, most of our income statements, or I'm sorry, our financial statements are based on GAAP accounting, which requires companies to use accrual accounting methods. All right? So that's just a historical standard that has become very commonplace in companies. So it's on the investor's part to make adjustments to look at cash flows. And so over time, financial statements have tried to accommodate that information, especially with now using cash flow statements included in the big three. So financial statements are going to have the line items that we need in order to put together the cash flows. All right, and kind of related to this, what is going to be a better way to predict future cash flows, right? If we have sustainable incomes that we're dealing with, or random or transitory incomes occurring. Yeah, more consistent a company's cash flow is, its revenues, all its expenses, getting down to the bottom line, the easier it's going to be to estimate future cash flows. And that's always going to be the case, right? Whenever you're looking at more consistent cash flows, you're going to be able to make estimates for future expected cash flows that much easier, right? A great reflection of that is something like utility companies. All right, generally speaking, utility companies' incomes are going to be very closely tied to basically just the population in the area, right? And if the population is growing at a particular rate, you can use that to estimate what the company's future cash flows are going to look like. Something that's less sustainable are going to be recent startups, right? Companies that haven't established a typical revenue base, a typical customer base. And so they're just starting to get off the ground, right? Some of you happen to have new companies that you're valuing, right? I think Rivian was a great example. The company had a relatively large relatively large change in revenue, but that was completely offset by a growth in expenses, right? So young startup companies, they tend to not have any established cash flows, right? And it takes time to get those cash flows generated at a relatively consistent level. Right, so generally speaking, when we are valuing investments, the easiest way to value them is if you're dealing with sustainable cash flows, and it's going to be a lot more difficult to value those companies if they have more transitory or still getting into their sustainable state. The flip side to this are companies choosing to have those more transitory components. So this is something that we're going to look at in a little bit with earnings management. Right? Sometimes companies will intentionally lump together expenses in order to make the argument that this was an abnormal expense. Right? And when we see stuff like that happening, that can be a little bit of a signal that earnings management might be significantly in play with these companies' financial statements, and we should very closely look at the company's cash flows. Right? Cash flows are not as manipulable as we've already pointed out. So converting our income statements to cash flows is a great way to really evaluate the company, especially when they're dealing with intransitory incomes. All right, so now we're going to look at the breakdown of some companies' financial statements that have the multiple steps. Right, like we've already discussed, when we're looking at the line items, there are points where there's kind of a break in that line item. Right, so what do I mean by that? So if we go from a company's revenues net of their cost of goods sold, you're looking at the start of operating profit. Or gross profit. You net out selling, general, and administrative, you have operating profit, right? And so there are different steps like that through companies' financial statements that break down the subcomponents and are important for us to look at when we're evaluating them. All right, so in this one example here, all right, we start off with sales of the company, net cost of goods sold, arriving at gross profit, selling, general, and administrative. Then we arrive at one of our unusual items, right? When you're looking at companies' financial statements, some of you have already seen this. You'll see some zeroed out time periods or some zeroed out line items, but then you see something occur in that line item in 1 year, right? So you have to figure out, how is this affecting the company's finances, right? So in this case, the company is explicitly laying out what is an expense, what is an income, and that's great, right? Cost of goods sold is reflected as an expense, so we're just subtracting it from the revenue. Selling, general, administrative expenses, again, subtracting it out. Unusual and frequently occurring items. This could be income to a company or an expense. Very important to keep this in mind when you're looking at your company's financial statements. This was a mistake that I saw several of you make, was adding when you should have subtracted or subtracting when you should have added back in. right? So it's important that you look at the line item and try to make sense of what is actually going on. In this example, we see that we're dealing with an expense. So starting from 2,500, net out 1,100, right? That doesn't bring us to 1,200. So we got to net out another 250. That's going to bring us down to the 1,250 operating income that this company is dealing with. All right, so when you're looking at the line items, you have to just go through and manually make sense of, is this actually an expense or a cash inflow to the company, especially when you're dealing with any sort of unusual line item. Right? And very often they will say something along the lines of unusual, infrequent, something like that, to give you a note that keep an eye on this specific line item and pay close attention to what comes after it. Are we going to be adding or subtracting this line item from the previous in order to arrive at the next step? Right? Every time you're going through financial statements, take the time to understand what's going on. Is this adding up to what should be expected? All right, after we take out our unusual item, brings us to our taxable income, net out our taxes, and we have our baseline income. But from here, we have discontinued operations, right? So operations that are no longer going on. So we might have this disposal of assets, right? What might be treated as an unusual good, right? So after we look at this item, so we have a income, we have disposal of some assets in place. That brings our bottom line income to $1,300. All right, so always keep in mind the line items that you're looking at and try to make mechanical sense of what's going on. Everything should add up at the bottom. Right? When you're putting together your income statement, you should arrive at the same net income that the company has occurred. And you can do that by going through each line and double checking that it's working out. Right? Just like we did with the Walmart example. Right? Each step should coincide with the financial statement as reported. All right. So starting with the top line item, revenue. All right. Revenue started off at $611,000. Good. Looking all right. From here, we have cost of goods sold of $463,000. Cost of, they refer to it as cost of sales over here, $463,000. Right. Some of you had your selling general administrative broken up into multiple things. You could have research and development. You could have marketing. You could have general and administrative expenses. Those are all under the general umbrella of selling general and administrative. Some companies will only report that. Right? So if you have those three, you can explicitly show each one. Totally cool. Right? That's actually a better way to go about it, is to explicitly show each of the line items rather than lumping it together. But as is the case with Walmart, it has all of those already lumped together under selling, operating, selling, general, and administrative expenses. Right? But again, your company could have these broken up into each individual line item and not aggregated like this company has. All right, so selling, general, and administrative, $127,000. So that brings us to our operating income. Right? When we calculate operating income, that should result in the same operating income that we see reported on the financial statement, the $20,000, and we have it. Right? If we don't arrive at the same steps, if we don't arrive at the same gross profit, operating profit, right, that tells us we have to go back and double check our work. All right? This step for verifying that we're getting the income statement correct is vital to make sure that your next step, the cause of change, is correct as well. All right, and these next steps here, this is where those miscellaneous items can come into play. Right? When we're looking at debt here, I lumped together our interest expense, loss on extinguished debt. And we also have our miscellaneous. So this debt expense, right, is a reflection of the three items above. Right? We have debt, finance, cost of finance leases, and interest income. All put together under the line item underneath it, lumping those together for the total debt expense. Right? But again, we're still arriving at the same value, $1,874, interest expense of $1,874. Right? And your different companies reflected different information here. Some companies don't lease, right? They purchase and own the land and buildings that they're operating out of, so leases aren't going to be relevant. A lot of companies tend to hold on to some investment assets with the additional cash that they have, so we should expect some interest income, but not necessarily. Some companies have a significant amount of interest income, so much so that they would be relevant to the company's operations, right? Companies with leasing arms and stuff like that. All right, so important that as you're going through these line items, you go back to the reported financial statement and make sure everything is lining up between them. Miscellaneous, right? Let's double check what we put in the miscellaneous expense. It was other gains and losses, right? Miscellaneous potential incomes. But again, is this something that's being added or subtracted from the company's financial statement, right? You have to go back and make sure that everything is working out, right? Are we arriving at that $17,000 taxable income when we're deducting these gains losses? Yes. Right? And as they're trying to signify in the line item definition here, gains would be subtracted out, right? Subtracting out a negative value actually adds it back in. Right? So with Walmart, all of the expenses are reported as positive values, so we're just subtracting them out. And the example that we're looking at here, expenses are reflected as negative values, so you'd add it in to subtract out. Right? Again, keep in mind how your company's structured, how its financial statements are reported, because each line item might interact differently than we're observing. But at the end of putting together your financial statement, you should be arriving at the same exact net income. And if you're not, go back through the income statement and figure out where the discrepancy is, correct it, and then keep working towards arriving at the same net income. And when you're looking at these infrequent items, usually there are going to be more information about them in the company's actual reports. All right, so if this was an actual company, we could look at their 10K, and usually there's going to be an item discussing why exactly this is occurring in this year and what were the economic events that resulted in this expense or income. The last little item we're going to be looking at is net income to non-controlling interest. All right, so basically the structure of this is you are the majority owner of a subsidiary, but there are other shareholders in that subsidiary, and their income is going to be your expense. Right? That's generally how it is, right? A cash outflow for you is a cash inflow for whatever the offsetting entity is. So when you have controlling interest of a company, you might have non-controlling expenses occurring because you have to pay out other shareholders in that company. Conversely, if you as the company have non-controlling interest, you're going to be earning some revenue from that company. All right, so let's say that we have this net income that a company is generating. 10% of it is attributable to an outside shareholder. Right? So after we deduct that non-controlling interest from our net income, that brings us to our net income attributable to all shareholders of the company. I don't think the company that we were using as an example, yeah, all right, so we've already arrived at attributable to Walmart. Oh, yeah, non-controlling interest. All right, let's see where we included that. Tax rate, investment. All right, so consolidated income or loss or income attributable to non-controlling interest. All right, so that means that Walmart is the owner of some subsidiary that other companies have a non-controlling interest in. So it just means they have some equity stake, some voting stake in it, and it's going to be a cash outflow from the company. All right, so very often you'll see it's a relatively small fraction of the company's overall incomes, but it's still going to be relevant to make sure that it matches up and gets you to the bottom line that you're looking for. All right, we're going to wrap up with talking a little more about earnings per share and earnings management. All right, so the general way that we measure earnings per share is net profit divided by the number of shares outstanding. And this is a metric that is very much focused on by companies, in large part because a lot of managerial contracts are tied to earnings per share performance. Personally, I think that is not the best way to tie executive compensation to company performance, right? Because earnings are not cash flows. Right? If you're not adjusting for the timing of cash, then it makes it much easier for pure accounting manipulation to result in the outcome that executives are trying to earn. And as we're going to see when we look at some survey results, that's one of the largest considerations for management decision making. Another metric of earnings per share that you'll often see is diluted earnings per share. All right, so let's see if we have that available. Yep, diluted earnings per share. Slightly lower than the regular earnings per share. And all diluted earnings per share is doing is, in addition to the shares outstanding of the company that are available in the market, it's including expected shares that are going to be issued in order to pay off executive compensation contracts. Right, so it usually is going to reduce earnings per share by a little bit, but very often diluted earnings per share is going to be the focus relative to the basic earnings per share. All right, so whenever we're looking at an income statement, after you arrive at net income, typically you'll see a little bit more information breaking down the earnings per share of a company and then breaking apart the diluted versus the base level of earnings per share. Right, so they'll give you some information on the number of shares outstanding plus the diluted earnings, the diluted amount of shares outstanding that the company expects to be issuing in the near future, and you can put those information together to arrive at the diluted earnings per share. Right, so all we're doing to get at the difference between basic and diluted is adding in the number of shares the company expects to be issuing. Right. So it's not a secret that companies can manage their financial statements. Right? Ironically, right, Jack Welch, any jerk can squeeze out short-term earnings. Right? General Electric is kind of ended up being a great reflection of that. Right? It was one of the last holdouts from the conglomerate era where companies just went on buy-up sprees, but conglomerations tend to not perform efficiently. Right, and we've seen that with the breaking up of General Electric now over the last, I think, 5 years now it started. But still, companies tend to engage in some form of earnings management, especially when the managers of those companies' incomes are tied to the earnings of the company. All right, so what we're going to be looking at here are survey results from managers and how they view the importance of different information and what their decisions reflect in that information being reported. All right, so how important are earnings benchmarks, right? So basically, what information is going to be most important? So basically what we're seeing here is that one of the most important factors in looking at earnings is that we're basically hitting our benchmark, right? And that benchmark is usually same quarter as last earning per share. All right, so why do you think we're going to be using the previous quarter's earning per share rather than the immediately previous quarter? All right, so in other words, if earnings are coming up in December, you're more concerned about last December's earnings per share rather than last summer or last fall's earnings per share. Yeah. So that is the question I'm asking. So why would you look at last December's earnings per share rather than the immediately previous earning per share? Yeah. Managers are looking to at least meet the level, right? But why the last year's focus over the immediately preceding quarter? Exactly. Yeah, similarity, right? Having a relative basis to compare, right? And what we know is that over the course of a year, spending habits can change, right? If you're a retailer, very often the holiday season around December is going to be a huge portion of your sales during a year, right? So would it make sense to compare this December to, say, last August? Because Those are completely different market situations. Comparing this December to last December, though, you're in a more similar situation. Similar with something like travel, right? People tend to travel more during the summer or winter holidays. People tend to travel less during the week relative to the weekend, right? So there are spending patterns that change over the course of a year. So comparing yourself to the same time last year gives you a more equivalent basis to judge that on. The second most important aspect was analyst consensus on forecasts. And this is a really interesting component. All right, so when you're dealing with a public company, analysts will report their forecast for the company's performance. But an interesting little component of that is typically analysts will present information that, or present a forecast that they expect that the company has a significant probability of exceeding. Right? If analysts were unbiasedly putting forth their forecast, we'd see that about 50% of the time companies would be above and below it. But I think it's closer to about 80% of the time companies are beating analyst forecasts. 75 to 80%, somewhere around there. Right? So analysts are consistently putting down their forecast estimates for companies' performance so that companies can much easier beat those forecasts. Right? And funny enough, both of those things beat out just generating a profit in general. Right? All right, so why are companies trying to meet those earning benchmarks? All right, so based on these survey results, a lot of it has to do with capital markets. All right, so build credibility with capital markets. That's not just going out to issue debt that the company might need to smooth out its cash flows, but it's also so that it's going to be potentially easier to engage in the company stock market, right? Issuing SEOs, stuff like that. Next is trying to increase the company's stock price, right? When people think about companies operating theoretically efficiently, this is not what we would expect, right? This could also be just a reflection of a poorly structured survey, and that's always an issue with surveys. Right? If the questions aren't sufficiently addressing all of the issues, then people are going to go with what they think is the next best thing, right? But when you ask people, right, what are companies trying to do, increasing stock prices are one of the typical answers that they respond with. Right? So the fact that we see building credibility and management reputation are some of the most prominent reasons for hitting earnings benchmarks, see that something might be a little bit off there. Right? What about failing to beat benchmarks? Right? So again, constrained by the earnings, or not earnings, the survey structure, right, creates uncertainty about future prospects. By far is what management were most concerned about. Right? And so there are a lot of things that can be tied to this. Right? If there is uncertainty on a company's future, that could immediately result in issues in the company's valuation. Right, their stock price taking a tumble, their cost of debt increasing if they need to take out any issues, but also customers might change their habits. Right, if customers expect this company is going to be going out of business, one of their first thoughts might be, "Oh, I have to figure out where else I can get the same product or service." Right, so uncertainty in and of itself can result in differences in both actual economic events, but also financial market events. That might be impacting the company. Right. And some other issues that are rounding out the top three. So previously unknown problems. So if MD&A is doing a good job, typically management will be forecasting what they expect issues in the near future are going to be for the company. And typically they are capable of predicting significant economic issues that's coming up in the company. But if there were unknown problems for the company itself, that just reflects that management were incapable of seeing those issues coming up. All right, and lastly, have time to explaining why we missed. This is a really interesting one. Right? Basically, they're just saying like they're trying to cover themselves and avoid the backlash for the negative performance that they saw. Right? In other words, they weren't capable of presenting that information in a way that could be viewed as positive. Right? So if you're expected to be below the desired target, what choices might you make to change in your operating performance? Right? And one of the top ones was decrease discretionary spending. Right? So management might view this as discretionary spending, but in a way, they're going to be necessary for the future performance of the company. Right? If Apple stopped investing in new iPhones, that's a huge cut to their future revenue. Right? Advertising is very important for letting people know about products and services that are being produced. If they don't know that you're producing this product or service, highly unlikely that you're going to be able to sell it. Maintenance, absolutely vital when you have assets in place that require upkeep over time. Right? If you don't give your car an oil change ever, eventually that's going to run itself out and you're going to have some serious issues that are extremely costly. Right? So these discretionary expenses that management cite are, in reality, expenses that are necessary for the company's well-being. All right, but after we start looking at these sort of delay cost sort of things, right? Book revenues now rather than next quarter, right? So this is where that that earnings management can come into play. If you have the option to book a revenue route now rather than next quarter, that's going to be increasing your earnings this quarter at the expense of next quarter. What is the effect on the cash flows, though? Right? And we can't really answer that until we look at the cash at the expenses also being incurred. But these are the sort of things that management might do when they have discretion over. All right, so very important to keep in mind when we're looking at financial statements, translate that information into cash flows, the least manipulable metric of value, and also adjust for the timing of cash flow. So keep that in mind that when you're looking at financial statements, there is some discretion over particular things. All right, so when we're looking at income overall, really what we're dealing with is the change in equity from this year's performance. Right, so when we arrive at our income, what we're dealing with is income that can be payable to shareholders or retained within the firm and invested in the future. All right, so we're dealing with net income or that other comprehensive income that we saw at the bottom. Right. Consolidated net income, additional interest income earned. All right, so both of these can show up on the company's balance sheet, typically through increasing retained earnings in the aggregate. All right, so looking at this example, let's say, again, dealing with the magazine, received $36,000 for 1,000 3-year subscriptions at $12 per year, starting in January. Right? How much would it report on the income statement for revenues on an accrual basis? All right, so for revenues on an accrual basis, we're just going to add the amount of value that's going to be occurring over the next year. Right? So we have the cash inflow, but again, we could recognize this revenue on an accrual basis and just break it up into those additional years. Right? And if this is over a 2-year period, then the remainder of that revenue would be recognized in the last year. Cash flow, on the other hand, looks a little bit different. We would be receiving all this cash at the front of this payment being subscribed. All right, so again, there are differences between accrual accounting values that we're seeing in an income statement and the actual change in cash that the company is occurring. Not a good situation to be in if you receive your cash after you incur your expense at a cash level. All right. This one gets a little bit more complicated. So let's say that we're looking at a manufacturer, right? And we got to put together some information on the financial statement. So We've had issues at the manufacturing plant, so we're selling that plant. Right? So in other words, discontinuing an operation. We have restructuring costs. We've paid off debt, wrote off inventory, and some equipment was sold at a loss. So let's go through these examples and talk about where on the income statement would this show up. All right, so after several years of problems, we've sold the plant off. Actually, I kind of already gave this one away. All right, so if we sell off a plant, where's that going to show up on the income statement? Discontinued operations. Yeah, right? So if we sell off a plant, that's going to show up under discontinued operations. All right, basically we're selling off assets that we've used in the past that are no longer going to be relevant to our ongoing operations. All right, restructuring costs. All right, so this is going to be a cash outflow, right? Cost that's going to be incurred. Where might this show up under the income statement? It's what? Yeah, restructuring expense. That could also be looped into selling general administrative if companies are just lumping it all together. Yeah. Right. So sometimes there's going to be contractually arranged payouts, parachutes, that sort of thing. So that being paid out, cost that the company is incurring. All right. So if we pay off $200 million in bonds, what might that show up as? Yep, extinguishment of debt. Let's see if our examples that we've looked at have. Yes, there we go. Loss on extinguishment of debt. All right, so companies paying off debt, going to show up under the interest component. Wrote off inventory that was not saleable. Right, so as companies are trying to make sales, they'll have inventory on hand. Great example is something like a grocery store. Right, if food sitting on the shelf ends up going bad, no longer a saleable item. So some companies might lump it under cost of sales. Another might be other gains or losses. Right. So again, companies have some discretion. If you're dealing with something like produce, something that can regularly basically just expire, no longer be saleable, companies should have a general idea on what % of their inventory they're likely to be selling. Right. So different line items can show up in different places. Companies may have discretion over where that is. And equipment sold at a loss. So I think, again, we have a line item that we've seen for this. Yes. Right. So other miscellaneous expenses. I think Honeywell had a better example. Let's see. No, I guess just unusual items would be a typical thing to look at. All right. So there are a lot of unusual things that we might see come up in the income statement. Companies that are well established, they should have some estimates on what the likely sales and expenses are going to be in a given time period. Right? Well-run grocery stores know what percentage of their items on the shelves are going to go are going to expire before they make a sale. Right? And there are things that they can do to avoid that, right? Going on sale and stuff before the expiry takes place. But companies will have some discretion over some of this information. And so just keep in mind what you might see as an abnormal expense is something that the company could have planned out and expense in a little bit more consistent situation. All right, so we had mentioned income attributable to non-controlling interest. We already saw that in Walmart, but we can also look at Honeywell. Let's see. Right, minority interest in earnings, relatively small amount, but these are items that you have to keep an eye on, right? And these are some of the issues that I tend to see come up with the second part of your project, right? You have to make sure that you're making sense of each line item expense or income to the company and making the appropriate adjustments. All right, so if, say this was reported as a positive value, as a positive value, if with Walmart, we directly subtracted it out. If it's reported as the negative item, like it is in Honeywell here, we would be adding it back in. Again, keep in mind your companies are going to be slightly different. Just pay attention to what the financial statements are showing you and try to make sense of them all. All right? But these are going to be one of the differences between income to the company and total net income attributable to shareholders. All right, let's look at Visa's lawsuit from 2018. All right, legal settlements. All right, hopefully you're dealing with, if you're looking at companies that aren't mired by lawsuits, these are one of the expenses you can see come out. Right, but this company had a relatively large lawsuit in 2018. All right, so these are some other potential unusual items you might see. Okay, doesn't give more information on what's included in here, but right, keep in mind that companies are going to have different expenses. Being sued is one of them. All right, so there are a lot of different line items that companies might experience. You can always dig in further into the company's financial reports to get information on each individual line item. There will be information in the 10K. Right, it's a very large, comprehensive document that covers the information being reported. All right, so any questions on income statement and putting together the bottom line? I know there's a lot of little details going on here. The important thing is always keep in mind the structure. When you're dealing with an income statement, you have your cash inflows, your revenues, net out the expenses. That's where things are going to get a lot more idiosyncratic between companies and arrive at your bottom line, right? You're going to be adjusting for unusual items. You're going to be adjusting for minority interest. Just keep in mind how exactly you're making that adjustment and make sure that your constructed income statement matches up with the reported one. Right? As long as you're doing that at each step, you'll arrive at the correct answer.